What's going on YouTube? Today we're going to be talking about buying the dip, what it is, what it isn't, why it works, what to watch out for, and some strategy. I think it's the perfect time to talk about that. This video, of course, is geared more towards newer investors, people who are just getting into the markets. I'm pretty sure if you've been invested for any decent period of time, you're familiar with buying a dip. Now, why is it important to talk about right now? Of course, as you've seen with this whole tariff situation, S&P 500 futures, NASDAQ 100 were deep into correction territory. I think the NASDAQ 100 actually dipped into bear market territory. So we've seen significant price drops from 52-week all-time highs. So with that being said, I myself have been buying the dip at different levels, lowering my average cost basis. So it's important to make sure new long-term investors know about this. So why does it work? Well, over the long term, historically, the stock market tends to go up more than it goes down. Stock market usually trends up historically over the long term. So buying the dip, buying at lower price points, once the stock price recovers and goes higher, you know, you're seeing those returns, and at different levels as well. If you bought a stock at 150, it drops, say, down to 130. You buy again at 130. Once the price gets back above 130, you're already in profit. Then once it gets to 150, you're even deeper in profit as it goes higher. So you want to buy at different levels so you can start seeing profit. That's why you want to lower that average cost basis, so you can see profit sooner, and kind of mitigate your your risk level. Now, first things first, buying the dip should only be used and only works, in my opinion, when you're talking about quality companies, companies with strong fundamentals, not just any old company. You want to make sure that fundamentally your company is strong balance sheets, good management, free cash flow, they have a moat, and on the reverse side, you want to make sure that you're not buying the dip on a company that has fundamental errors, that has bad management, that has bad cash flows, companies that aren't necessarily profitable, companies that are losing their moat, losing their competitive edge, being replaced by another company. You don't want to be, there's a difference between buying a falling knife and buying the dip. So you want to make sure your company that you're buying the dip on is sound fundamentally. You don't just want to be doing this strategy on any and everything. Secondly, you have to be prepared. Stay ready so you ain't got to get ready. Have cash on hand. You know, start putting money into those brokerages account, into your brokerage account. Here, 100 here, 50 there, 20 there, 200 here, whatever it may be. Build up that brokerage account. Build up your freedom fund, your investment fund, whatever you want to call it, and be ready. So when those dips come, when we have those corrections, you have the capital to be able to capitalize and buy those dips. So you got to have your money on point. And again, stay consistent, stick to the plan, zoom out, think long term, 5, 10, 15, 20 years. Don't necessarily care what's going on in the short term when you're thinking from the perspective of a long term investor. We welcome uncertainty in the market. We welcome that VIX getting above that 40, 45, 50 level because we're looking for buying opportunities to buy the dip and lower our average cost basis. Now, I've talked about risk to watch out for. You don't want to catch falling knives. You don't want to be buying into companies that, have, like I talked about before, fundamental errors. Their moat is being taken over by another company. They're having money issues, they're having supply chain issues. Look out for those things. Bear market traps. Be patient. Be patient, because don't spend all of your capital at one entry point. If you first bought a stock at 150, it drops down to 130, and you have $1,000, in your brokerage account ready to strike. Don't put the whole thousand in at that price point. Maybe put 250 in. Let it fall a little more, put another 250 in. Let it fall a little more, put another 250 in. That's what I like to do. Be patient. If you're at one stock price, you let that thing fall, you know, 10%, you put a little more capital in. It falls another 5% or 10%. Now you're down 15 or 20%. You put another 250 in. It falls some more, you put another 250 in. It goes back up. Great. Now you're starting to see that profit. Now you're starting to see those returns. You've lowered your average cost basis and everything's okay. You know, don't be over leveraged. Don't go in too early. Be patient. Have a balanced approach. Now, I think I've covered everything, man. Buy the dip. Buy these companies strategically. Buy at different levels. If you buy at one price, let that correction happen. Let it fall. It all depends on what you want to do. Me personally, I'm looking to see at least 10%, that I'm buying that dip. Comes down a little more. Now it's down 15%. I'm putting a little more capital in. It comes down 20%. Now I'm buying a little more. 25, 30. I'm constantly buying those different levels as it drops. 10, 15, 20, 25, 30, 35, even 40%. Like we've seen with Tesla this year. Buy at those lower levels, lowering your average cost basis, and then when things start to turn around, you know, when your stock price starts to recover, you're in the green a lot faster. You're starting to see profit a lot faster versus if you bought it, let's say $150, the price drops to 100. You have to wait all the way until that stock price gets back to 150 to break even, and then it has to go higher in order for you to make a profit again. Versus if you bought at different levels, 140, 130, 120, 110, 100, you bought it down, as you're hitting those levels again on the way back up, you're starting to get in profit a lot sooner. See what I'm saying? That's the whole premise of buying a dip. Over the long term, it's going to put you in a better position. It's going to strengthen your position, mitigate your risk levels, put you in profit faster, and it's just a good strategy, man. Dollar cost averaging, something I'll talk about a lot, you know, and it just gives you the opportunity to buy different levels, So that's just what I wanted to talk about tonight, man. I don't want to get the rambling, man. If you got any value from this video, please like, share, and subscribe. Share this with a new investor. And like always, I love y'all, man. Thank y'all for tuning in.